Hello, welcome into the NetPicks Options Trade of the Week video. For this upcoming week, we're going to take a closer look at the energy sector. For most of this year, the commodities have been very active, and oil is no different. We've seen some pretty big moves in both directions, back and forth, over the past few months. As a result, I'm expecting energy to get a little choppy in here, to establish a little bit of a range that we're going to stay inside of. So for this week's Trade of the Week, we're going to take a look at Halliburton. We're also going to take a look at selling an iron Condor. I don't want to be directional here. As I just mentioned, I'm not expecting big movement back and forth here over the next month or so. So instead of coming in and buying a call or a put, or buying a call spread or a put spread, I want to go ahead and put on more of a neutral trade. And an iron Condor benefits from a stock staying inside of a range. It's essentially a way to generate some income from time decay and from volatility movement. Let's go ahead and dive in and take a closer look at this trade specifically. So looking at the chart, you can see the big moves over the past couple of months. First to the upside, then since the first of the year, we have pulled back, and now we're starting to see a little bit of chop kicking in here. So based on my outlook, I'm trying to establish a trade that will profit from Halliburton staying inside of a defined range. Let's go ahead and take a look at the trade page, and let's piece this trade together. So first of all, I want to point your attention to the bottom of the trade page here for Halliburton. You can see that the IV percentile is at 57. Why that's significant for us, anytime that the IV percentile is above 50, it indicates to me that the options are more expensive. There's more premium there to collect. And when that's the case, we're able to create a wider profit window. We can stretch our break-even points out wider on Halliburton. That way it gives us a higher probability of success. And you'll see that more in just a second when we take a look at the trade in detail. So again, anytime the IV percentile is above 50, it's the market's way of giving us the green light to sell premium, to sell a vertical spread, or in this case, an iron Condor. So our next area of focus needs to be on the different expiration cycles. We need to decide how far out in time do we want to go. I could go all the way out to April. They have 49 days left to expiration. The problem with that, I don't necessarily want to hold this trade that long. I'm expecting Halliburton to stay choppy in the near term. So I'm more focused in on the March monthly options with 14 days left. That's going to leave me with a trade that's more reactive. The profit is going to pick up in our favor quicker by going with those shorter term options. And that's due to the time decay picking up the closer we get to expiration. So we're trying to take advantage of that feature. So I'm going to open up the March monthly options. Again, they have 14 days left. To put on an iron Condor, we're looking to sell an out of the money call spread and an out of the money put spread at the same time. A lot of times people get confused by iron Condors, and it can be a complex trade because there's 4 different options as part of the trade. But when you start to get into these complex trades, the best way to do it is to break the trade down to its components. So even though the name sounds a little funky, all we're looking to do with an iron Condor is to sell 2 vertical spreads at the same time. And by doing it, we're trying to box in the price. We're trying to create that defined range that we expect Halliburton to stay inside of. So what I did here is I went to the out of the money calls and to the out of the money puts, and I started to piece a trade together. And what I found here was by selling the 47-48 call spread and the 44-43 put spread at the same time, I can collect around 44 cents mid-price. By collecting 44 cents, that's $44 per spread. That's the most money I can make on the trade. So at initial glance, you're looking at that saying, well, $44, is this trade even worth it? Well, let's go ahead and click confirm and send here a second. The beauty of this trade is it's only tying up $56 of capital per spread. You can put this trade on 10 times and have less than $600 of risk. Now all of a sudden, when you start talking about a $440 profit over the next 14 days, that's a little bit more appealing to me. And keep in mind, what we're trying to accomplish with this trade is to generate a little income in a choppy period, in a choppy move on Halliburton. If I was expecting a big directional move higher or lower over the next couple weeks, there's going to be far better trade types to use. It'd be better off for me to buy a call or a put at that point. But because I'm expecting the choppiness, this is a way for me to generate a little bit of income when the market's not moving. So we're right around a risk 1 to make 1 type of scenario. So pretty good situation there. our break-even points are going to be at 43.56 and 47.44. Those numbers are calculated by taking our short strike. So on the call side, we sold the 47 call. We collected 44 cents for the trade. We add on that 44 cents and it gives us the break-even point at 47.44. We also sold the 44 put. We're going to take that 44 cents and we're going to subtract it from that short strike on the put side. So that's where we get the 43.56 on the downside. All I need Halliburton to do is to stay inside of those two numbers. I don't care if it moves up, down, or sideways during that stretch. As long as it stays inside of that defined window, we can make money on the trade. All right, so let's go ahead and take a look at those break-even points. Go ahead and shrink this back down. So if we go ahead and take a look at our break-even point being right up around 47.50 on the upside, if I go to that 47.5 call, it has around a 72 to 73% chance of closing out of the money. What that's telling us is essentially Halliburton has around a 73% chance of closing below 47.50. That's exactly what we wanted to do, right? We just talked about that with the profit window. So that's a pretty good number. That's a pretty high probability of that happening, right? Let's take a look at the break even on the downside. We mentioned on the downside, our break even's down around 43.50. Well, that 43.50 put has around a 79% chance of closing out of the money, right? So essentially, we've got a 79% chance of Halliburton staying above that number. So can you start to look at these probabilities? We have a 73% chance of closing below our break-even point on the upside. We have about a 79% chance of closing above our break-even point on the downside. We're starting to piece a trade together where the probabilities are really heavily in our favor. It doesn't guarantee that this trade is going to work. There's not a 100% probability of price action staying inside of the window. But when you start to take a look at the numbers, we're collecting a decent profit, right? Decent premium. We're risking one to make one. We've got probabilities of around 75% working in our favor. There's a lot of factors that are adding up here on this trade. We can make money if price action moves up, down, or sideways, as long as it stays inside of that defined range that we talked about. I make money from time decay adding up, and I make money from volatility decreasing. We mentioned the volatility right now is a little high. Over time, we'll most likely see that volatility contract. So we're piecing a trade together that would benefit from volatility contraction. Okay, so now I've got 5 different ways of making money on this trade. This is a way for us to expand our toolbox out. None of us know what the market is going to do next. As much as we love to play the long calls, long puts, and go for the big profits, the market is not always conducive to giving us those types of moves. So I want to mix up my trade types. Sure, I love to play the long calls and long puts, and I will going forward. We've had some really nice results with those types of trades over the past few weeks. But I also want to build in some layers of diversification here. I want to get on some neutral trades as well, just in case this market does hit the pause button here over the next few weeks. So this is another way for me to build in those different layers of diversification. So as you can see, a pretty neat trade, pretty powerful trade. If you're not used to trading the iron condors, if it's a new concept to you, go ahead and track this trade over the next few weeks. You don't necessarily need to place it in a live account, but go ahead and track it. You can get a feel for how the P&L reacts to changes in time and changes in stock price, and it may be something you want to add to your toolbox here going forward. All right, so we'll track this one here on the blog over the next couple of weeks. If you have any questions on this trade, certainly let me know. You can leave a comment on the blog or feel free to send me an email directly. My email is mike@netpicks.com. All right, so we'll be back with you next week with our next trade of the week.